I used to spend countless hours trying to time the market, buying low, selling high, chasing trends. But eventually I realized it was more stressful and less effective than I imagined. So I decided to quit timing the market altogether. What happened next surprised me. Instead of constant worry and second guessing, I found a new approach that brought more peace and better results. Here's my story and the lessons I learned after stepping away from the endless market guessing game. Today we will talk about I quit timing the market. Here's what happened next. So before we start, make sure to hit the like button and subscribe to my channel. 1. The market timing method. For years, I believed that market timing was the key to successful investing. The idea that you could buy low, sell high, and avoid downturns sounded logical and appealing. I spent countless hours analyzing charts, news, and economic indicators, trying to predict market moves. However, I soon realized that timing the market perfectly is nearly impossible. Even professional investors and fund managers struggle with it. The markets are influenced by countless unpredictable factors: geopolitical events, economic data, company earnings, and investor psychology. This realization forced me to reconsider my approach. I understood that instead of chasing short-term gains, I needed a long-term strategy grounded in patience and discipline. 2. Emotional roller coaster of timing attempts. Trying to time the market often felt like an emotional roller coaster. When the market was booming, I feared missing out and jumped in too early. Conversely, during dips, panic would push me to sell at losses, only to regret it when prices recovered. This cycle of fear and greed eroded my confidence and returns. I discovered that market timing can create anxiety and second guessing, distracting me from my broader financial goals. This emotional toll is often underestimated. Investors who attempt to time the market are prone to cognitive biases like recency bias, overreacting to recent events, and confirmation bias, seeking information that supports their fears or hopes. These psychological pitfalls only make timing more challenging. 3. The impact on portfolio performance. My portfolio's performance reflected the pitfalls of market timing. Frequent trades and misjudgments led to inconsistent results. Studies show that missing just a few of the best market days can significantly reduce long-term returns. Ironically, I often miss these days while trying to avoid downturns. By trying to anticipate every market move, I increased transaction costs and taxes, further reducing my net gains. This experience underscored the importance of staying invested rather than reacting to short-term fluctuations. Over time, I realized that a buy-and-hold strategy with diversified assets provides more stable growth. This approach helps capture the market's upward trajectory while minimizing the risks of timing errors. 4. Shifting to a long-term investment strategy. After quitting market timing, I shifted to a long-term investment strategy, focusing on asset allocation and diversification. Instead of predicting short-term market moves, I prioritized building a portfolio aligned with my risk tolerance and goals. This involved a mix of stocks, bonds, and other asset classes tailored to different market environments. I'd also embraced dollar-cost averaging, investing a fixed amount regularly, to mitigate the impact of market volatility. This disciplined approach reduced my emotional involvement and helped me stay committed through market ups and downs. By focusing on fundamentals and long-term trends, I gained clarity and confidence in my financial plan. 5. The role of patience and discipline. Patience and discipline became the cornerstone of my investment journey. Markets inevitably experience cycles of growth and decline, but over time the trend tends to be upward. By resisting the urge to react impulsively, I avoided costly mistakes. Staying invested allowed me to benefit from compounding returns, a powerful force that grows wealth exponentially when reinvested. I learned that the most successful investors are not those who time perfectly, but those who stick to their plan consistently. This mindset shift was transformative. I stopped obsessing over daily market news and started focusing on long-term goals like retirement, education funding, and financial independence. 6. Lessons from market downturns. Market downturns tested my resolve but also taught me valuable lessons. Instead of panicking, I viewed corrections as buying opportunities. For example, during market declines, I increased my contributions to take advantage of lower prices. This strategy, called buying the dip, helps lower the average cost of investments over time. I also realized that downturns are natural and necessary for healthy markets, allowing valuations to reset and companies to strengthen. These periods highlighted the importance of having an emergency fund and maintaining a well-diversified portfolio to withstand volatility. Ultimately, downturns reinforced my commitment to a steady, long-term investment approach. 7. Avoiding common market timing traps. Quitting market timing helped me avoid common traps that many investors fall into. One such trap is the temptation to follow the crowd during hype cycles, which often leads to buying at market peaks. Another is selling out of fear during crashes, locking in losses. I also learned to be wary of market predictions and sensational headlines that create noise rather than insight. By ignoring short-term noise, I reduced stress and improved decision-making. I also automated my investments, removing emotional biases and ensuring consistent contributions. This systematic approach prevents impulsive reactions and keeps the focus on long-term growth rather than short-term speculation. 8. How financial advisors can help. Working with a financial advisor helps solidify my new approach. Advisors provide objective guidance, personalized planning, and emotional support during volatile times. They help craft strategies tailored to individual circumstances, balancing growth with risk management. Advisors also educate investors on market history and behavior, reducing anxiety around downturns. By outsourcing market timing decisions to a professional, I freed myself from constant market monitoring. This partnership helped me stay disciplined and confident, ensuring my investment plan aligned with my evolving goals. It also reinforced the principle that successful investing is about planning, patience, and execution, not timing. 9. The transformation and what happened next. Since quitting market timing, my financial journey transformed. My portfolio steadily grew, and I experienced less stress about market volatility. I gained a deeper understanding of how markets work and the importance of a well-constructed plan. More importantly, I reclaimed my peace of mind, knowing that I was building wealth methodically rather than chasing fleeting trends. The lessons I learned extended beyond investing to personal growth, embracing patience, discipline, and resilience. This change empowered me to focus on what truly matters: long-term goals, financial security, and enjoying life without the constant worry of market timing. Quitting market timing wasn't just a strategy shift, it was a mindset revolution. 10. Embracing financial education and continuous learning. Quitting market timing also sparked my commitment to ongoing financial education. Instead of chasing quick wins, I began focusing on understanding market fundamentals, economic cycles, and investment principles. This knowledge empowered me to make informed decisions and resist sensational headlines or panic-driven moves. I explored topics like behavioral finance, asset allocation, and tax-efficient investing, which deepened my appreciation for a disciplined long-term approach. Continuous learning also made me more adaptable during market changes, helping me adjust my strategy thoughtfully rather than react impulsively. By embracing education, I transformed from a reactive trader into a confident, informed investor, a mindset that will serve me well for decades to come. This journey reinforced that successful investing is a marathon, not a sprint, built on knowledge, patience, and perseverance. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.